it's going to be a very volatile week. But wait, there's more. Because in addition to all of the economic news that's coming out this week, we also have some major company earnings. Hi guys, it's Stock Curry, and this could be the biggest week of the year for the stock market with a ton of economic news coming out, as well as some major earnings and a Fed meeting. I'm going to tell you everything that you need to know, so let's get into it. Here's why the stock market rallied over the past 3 weeks. Over the past 3 weeks, the stock market has been on a massive rally, with some stocks like Tesla up over 50%. And there are some really good reasons for this rally. For starters, the PCE, or Personal Consumption Expenditures Price Index, which is the Federal Reserve's preferred inflation gauge, has gone down for the 4th month in a row, reaching just 5.0% in December. On top of that, the GDP estimate was 2.9%, showing the second quarter in a row of positive GDP, eliminating the recession fears that many had had earlier in the year last year. And adding credence to a strong economy, the job numbers for December showed that employment rose by 223,000 jobs, while the unemployment rate dropped to 3.5%. So inflation is coming down while the economy remains extremely strong. All of this points to the possibility that the Federal Reserve might actually achieve a soft landing. A soft landing is when inflation gets back down to 2% while the economy avoids a recession. So far, it appears to be some really excellent news. But we have to dig a little bit deeper to understand what's really going on behind the scenes, because a lot of this data that we're getting is backward looking, and things could change quite rapidly. One of the risks to inflation is the fact that gasoline prices are starting to rise, and the cost of renting or buying a home continues to rise as well. So the amount of money that we're paying for shelter as well as energy is starting to go back up, which is causing a little bit of concern that inflation might start going back up as well. And further, as you're going to see a little bit later in this video, the Federal Reserve is also concerned that a very strong job market could cause inflation to come back. So it's not necessarily the case that the Federal Reserve is going to stop raising rates and going to start a reversal and lowering rates again very soon. That is just not the case at all. And actually, the reason for the rise up over the past 3 weeks is a very different reason than just good economic reports. And I'm going to show you in a minute what those reasons were. But first, I want to dig into these job numbers a little bit deeper. Because while the official jobs report showed that 223,000 jobs were added in December, there's another jobs report called the Household Data Index, and this shows a very different picture. In the household data, there was only an increase of 136,000 jobs in December. So why does the U.S. Labor Department show an increase of 223,000 jobs, while the Bureau of Labor Statistics shows only an increase of 136,000 jobs? That's nearly 100,000 job difference. So why the big disconnect? Well, it's important to understand that the labor report, the official jobs data, is counting jobs. It doesn't matter if those jobs are full-time jobs, part-time jobs. It doesn't matter if somebody who was unemployed got a job, or if somebody who's currently employed went out and got a second job or even a third job. The official job numbers don't care. All they care about are the number of jobs added. Those jobs could be full-time, could be part-time, could be somebody already working or somebody unemployed who now found a job. So it's a very wide range. On the other hand, the household data counts people, not jobs. So the household data is looking at how many people got jobs. So if the number of jobs added was 223,000, but the number of people who now have jobs is 136,000, What that means is that nearly 100,000 people went out and got a second job. So why are so many people going out and getting second jobs? Well, the reason is because inflation has gotten quite high and people can no longer afford to pay their bills. So people are going out and they're getting second and even third jobs in order to pay their bills. So while the official jobs data looks really good, once we start incorporating the household data into the jobs numbers, you very quickly realize that things aren't quite as rosy as they seem. And things get even worse when we look at the number of people who are now working part-time. Remember, the number of people who gained jobs was 136,000, and the total number of jobs gained was 223,000. But look at the increase in the number of people who have part-time jobs. It was a 190,000 job increase for part-time due to economic reasons, and a 402,000 increase for part-time jobs not for economic reasons. What that means is in total, 592,000 jobs were part-time. So wait a second now, because if we have 592,000 part-time jobs added, but 233,000 total jobs added, what this means is that we had 592,000 part-time jobs created, but if you only had 233 total thousand jobs created, then that means there was 370,000 full-time jobs lost. So we lost 370,000 full-time jobs. We gained 592,000 part-time jobs, which gave us a net gain of 233,000 total jobs. This is really bad because if you just look at the full-time jobs, it's actually decreasing. The number of full-time jobs is going down significantly, and this would actually fall in line with all of the layoffs that we've been hearing about. Not good news at all, and it's showing up in another report as well. Private sector worker pay has now started to go down. You can see how the average hourly earnings is declining in its rate of growth. And this is not just because inflation is starting to slow down. This is because more and more people are losing their full-time jobs and they're going out and getting multiple part-time jobs, which don't pay as well as a full-time job does. So in summary, while the economic data that is backwards looking shows a very strong economy and a very strong job market, the forward looking data, which is the housing data, shows that the economy is really slowing down and things are not going to be looking good in the future. And this has caused a lot of debate within the Federal Reserve about whether wages or low unemployment are going to drive inflation back up. Easing prices as well as wage data are kind of at odds with concerns that the job market is too tight and the economy is operating above capacity. Federal Reserve officials have voiced unease that prices could re-accelerate because labor markets are so tight. Some inside the Fed, including its most influential staff, have put more weight on the latter, which would argue for tighter policy for longer. Now, the Federal Reserve is still likely to raise interest rates on Wednesday by a 0.25 percentage point to a range between 4.5 and 4.75%, which would slow the rate of rate increases for the second consecutive meeting. But then they are likely to debate about how long to continue raising rates and how long to hold them at that higher level. Now, a lot of people believe that because inflation is coming down, that the Federal Reserve is going to stop raising interest rates and even start lowering them once again at the end of the year. But Jerome Powell has said something very, very different. Fed Chair Jerome Powell said the central bank wants to avoid repeating its mistake from the 1970s when policymakers cut rates too early, resulting in a prolonged period of runaway inflation and uneven growth. When they cut rates, it's going to be because there's real weakness in the economy. In other words, the Federal Reserve is not going to cut interest rates until we enter a recession. Now, over the past 3 weeks, as the stock market has rallied on hopes that the Fed would start cutting interest rates, short sellers have really started to feel the pain. And highly shorted shares are beating the S&P 500 this year, with short sellers now down by $81 billion in losses. And this leads us to the real reason why the stock market rallied so much over the past 3 weeks. Short sellers who have incurred hefty losses are actively trimming their positions. Remember that when a short seller closes a position, they do so by buying the stock, which causes the price to rise. And this leads to a short squeeze, as highly shorted stocks have significantly outperformed the broader market this year. So the reason for this massive stock market rally over the past 3 weeks may have been triggered by hopes that the Fed would start cutting rates, but ultimately it was driven by a short squeeze amongst short sellers. Now, some investors are warning that a prolonged rally of speculative assets could loosen financial conditions all over again and set the Fed's fight against inflation back. They're worried that loose financial conditions could cause inflation to start ramping up once again. Others, though, say a rally driven in part by a short squeeze looks vulnerable to a swift reversal. So some people are arguing that we're not going to have a prolonged rally, but rather this short squeeze rally over the past 3 weeks is going to reverse course very quickly. Here's everything you need to watch out for that will move the markets this week. Now, regardless of whether you think this market rally that has started over the past 3 weeks will continue or if it will come to a swift end, the fact is this week could change everything just because of the massive amount of economic data that's coming out this week. Jobs reports, wages, openings, labor market, and Fed meetings will all move the markets this week. On Tuesday, the Labor Department releases its Employment Cost Index for the fourth quarter, which captures employees' labor costs by measuring wages and benefits. I just showed you a chart a minute ago showing how the increase in wages has started to slow down. It'll be interesting to see if this increase in wages continues to slow down or not. If wages start to rise back up in this Tuesday report, it could cause the market to go down over fears that inflation might start to ramp back up. However, if the wage costs continue to decline, this could push the market even higher on Tuesday. Also on Tuesday, the S&P Global releases its S&P CoreLogic Case-Shiller National Home Price Index, which measures the prices of homes across the U.S. That index fell 0.5% in October, and now we are going to get the November data. Also on Tuesday, the Conference Board releases its January Consumer Confidence Index. Keep in mind that Jerome Powell has repeatedly said that they're not necessarily trying to manage inflation, but rather they're trying to manage inflation expectations. And this report that comes out on Tuesday during the Fed meeting will show the Fed whether consumer inflation expectations are starting to go down or if they're ramping back up again. Then on Wednesday, we have the February FOMC meeting where the Federal Reserve will announce its latest interest rate decision. Again, they're widely expected to do a 0.25% rate increase. But before that number comes out, early in the morning, we also get the Labor Department's release of the December data on job openings, quits, hires, and layoffs. This is going to show how many job openings there were. Keep in mind that one of the things the Federal Reserve has been very concerned about is the fact that we have far more job openings than we have available workers, showing a very tight labor market. And the Federal Reserve is concerned that this tight labor market could cause inflation to come back again. And finally, we have the January inflation figures for the Eurozone. Then on Thursday, we get the initial jobless claims, and then we also get the fourth quarter data on U.S. non-farm labor productivity, as well as labor costs. And if that wasn't enough job data for you, we also get on Friday the labor market data for January, including the number of job gains, unemployment rate, and average weekly earnings. So it is going to be a packed week full of economic news this week, which is going to cause some pretty significant moves in the market, both up and down. It's going to be a very volatile week. But wait, there's more. Because in addition to all of the economic news that's coming out this week, we also have some major company earnings. Tuesday before the open, we've got ExxonMobil, UPS, GM, Pfizer, Caterpillar, McDonald's, Spotify. And after the close on Tuesday, we've got AMD and Snap. Then Wednesday before the open, we've got Waste Management. And then after the close on Wednesday, we've got Meta. But all of this is going to appear like child's play compared to what's going to happen Thursday after the close. Thursday after the close, we have Amazon, Apple, Alphabet, Ford, and Qualcomm. That's right. 3 of the 5 biggest companies in the world are reporting earnings Thursday after the close. So Friday, we could see a massive move in the markets depending upon how these earnings come out Thursday after the close. Also keep in mind that even if one of these companies reports good earnings and another reports bad earnings, those could cancel each other out and cause the stock market to trade fairly flat. However, if all 3 companies report good earnings, then we could see a massive rally on Friday. But if all 3 companies report bad earnings, then we could see a massive sell-off on Friday. So keep your eyes on the earnings coming out on Thursday, because that is going to be a significant mover in the markets on Friday. And we can also expect a massive gap up or down when the market actually opens on Friday morning. Now, I know that was a lot to keep track of, so if you want to know all of the moves that I'm going to be making this week and everything that I'm going to have my eyes on, then make sure you come join us in my coaching program, where I'm not only going to show you my trades, I will also be teaching you how to trade options so that you can make money no matter what the market does, whether it goes up, down, or even trade sideways. If you're interested in that, you can come join the coaching program at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family, and make sure you hit the like button and subscribe. I hope you have a lot of success trading, and I will see you tomorrow.